Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. February 25th, just after the close. Nice flat week. Nothing to see here.
Crazy week, man.
You know, it's tough to believe. We go back to last Friday, indices flat, basically. You know, let's call it up or down 20, 30, 40 basis points. And if we go back a month, indices flat. It gets to one of the things we've been discussing, and that is when you're in a tough market, especially a downtrending market, it pays to slow down.
Right.
You're going to get multiple chances here. Don't react to every headline. Don't react to every news flash. The market is remarkable at pricing in headlines, but it takes time. And the headlines are coming at us fast and furious.
Unbelievable.
And you see the fact that from the open on Thursday, NASDAQ down 3%, closes Thursday afternoon up 3%. 6% intraday move. Reminds me of '08.
Right.
That's when by the way, we started getting those kind of moves on a regular basis. Different scenario. Broken banks, we talked about this, broken insurance companies. Much stronger scenario in terms of balance sheets and strong economy here. So in my estimation, I think you can trust the VIX a little bit, that it's backed off. The VIX is a tell for, or a handicapping piece that tries to forecast 30 days of volatility in the equity markets. Let's call it the S&P 500. It's backed off. By the way, in January, the VIX hit almost 40. Even with everything we saw this week, it couldn't climb back up to 40. And it goes out in maybe at 26, 27. Not that that number is important, but the fact that it's backed off may mean that some of this volatility is about to calm a little bit. Doesn't mean there still isn't a ton of trouble between Russia and Ukraine. Doesn't mean there's not plenty of trouble around the corner with the Fed arguing over how many rate hikes and 25 or 50, but important to try to stay grounded. And what I keep reminding myself is when I get off the reservation and think I'm smarter than the market is when I pay the price.
Right.
And I talked a little bit about some of the securities that aren't working for us last week. But it just hit home again this week, John, how relative strength can never be ignored in any market, but in the equity markets. What worked best today? The same thing that's been working for the last 2 months. Metals and miners. We own XME and Tactical Trend, up 5%, new highs. Berkshire Hathaway knocking on the door of new highs. Things that were working before this week
Back working.
are working.
Right.
So sometimes I try to outthink it, and this is cheap, and how I look at this level, and relative strength never lies because it's price.
Right.
So what about in bonds?
Bonds, kind of the same, you know, all over the place this week, but you kind of ended up just a little cheaper than where you started. You look at something like a 10-year bond, ended up at a 197, about 4 ticks higher than it began the week. However, it says it all in like yesterday, where you started the day yesterday coming in from Wednesday at 2%, went all the way down to a 185 yesterday as the bid was in Treasuries. This happens every time you have a conflict.
Fear,
and people run to the safety of Treasuries. So, you know, without that this week, you probably would have been a little higher in yields with the same stories of inflation, etc. Fed starting to raise rates next month. Along with that, though, you actually saw Muni Yields, you know, dip about 4 or 5 basis points this week. Why? Strong demand and cheap deals. You know, we're starting to venture out and buy some longer bonds for the first time in well over a year. You know, 3 and change doesn't sound that much until you compare it to a long treasury at 220, and it sounds somewhat inviting.
3 and change with a taxable equivalent for a lot of people up through 5, right?
Exactly. So, you know, they're starting to see value. I haven't seen value in the longer end of the muni market in quite a while. We have a couple of charts just to show you when we think we might have volatile markets here. Take a look at these 2 charts showing the government bond yields of Russia and Ukraine. So you have a country that's being assaulted and the assaulting country, and both bond markets are suffering greatly. And why? Because that is risk on in a bad way.
Yeah, the Russian market, and you could represented by, say, RSX, which is a Russian ETF,
Right.
was down on Thursday over 30%. Now, it had already been down 20-25% coming into Thursday.
Right, right.
So, and you know, Putin knew that was coming, because if you went back to 14 with Crimea, the Russian market was off 60% during that period.
Absolutely. The same themes tend to repeat themselves. So, you know, quiet week from an economic standpoint. You know, new home sales down a little bit this week. Not that surprising when you know, from last month, when you think about the fact that house prices have risen so much that affordability is becoming an issue. So, you know, some of the seeds of slowing inflation are being built into the market right now. Things like home sales coming down a little bit. Consumer confidence lower. Why is it lower? It's not lower because the economy is not doing well. It's lower because people are fearful of inflation. They measure inflation by looking basically what's going on at the gas pump and what's going on at the grocery store.
Sure. And on the home buying front, I did notice where 15-year was up through 4% this week, right?
Right.
15-year mortgage?
15-year mortgages, right.
So we haven't seen that in a long time.
Costs a little more.
David Kotak and I had a conversation Thursday morning when, you know, futures were off 3% and so forth. And I'd love to hear your opinion. My thought, and David agreed to some extent and wrote a little bit about it, some of this geopolitical headline work and Ukraine and Russia in a war may put those 6, 7, 8 hike fears on the back burner for now. Maybe we're looking more 3 or 4, or is it just too early to tell?
No, I would agree with that. And I think the market felt that way a little bit yesterday, which is why you saw stocks kind of rebound, saying, oh, the Fed will not be out hiking rates as fast. I never thought that they were going to be hiking at the rate of 6 or 7 anyway, because for a Fed that hasn't done anything in 3 years of hiking rates, a pace that fast, whether you should have started it before is an open question, it might break something. So I actually think that Jay Powell and the rest of the Fed board would be more managed anyway. And if you have an international crisis in the background, they'll probably be more measured going forward.
Sure. Yeah, be interesting to see. Well, thank you very much for joining us. Don't forget to subscribe, turn on your notifications. With these kind of markets, we may have a midweek note to put out. Everybody enjoy the weekend. Hopefully things start to back down a bit over in Eastern Europe, but that's going to be a problem that stays with us for a long time. Enjoy the weekend.